Okay, good morning. I'll make a start. Thank you for registering to attend this morning. We had run this webinar back in October, which was quite well received, and we were told through the feedback that we'd like to run it again ahead of tax year end. So there's actually over 150 people registered today. So thank you everyone that has attended this morning. My name is Steve Powell. As you can see on screen, I'm the sales director here at Deepbridge, and this is the first of 3 episodes in this Deepbridge Academy series where I'll be discussing EIS investments. Today's session will last no longer than 45 minutes, so if you do have any questions, then I'm not sure if the Q&A functionality is available. I don't think it is, but please, you'll see my details on screen at the end to send me any questions because this is live. So as soon as this webinar is finished, then I will be available to answer any questions directly, where my details can be shown on screen at the end. Okay, before we start, I've got to provide a risk warning. As you know, and probably aware already, EIS investments are deemed high risk and suitability should be undertaken prior to recommending an EIS or SEIS for that matter to a client. Everything we're discussing today is correct as of the time of this presentation, such as the legislation surrounding EIS. Past performance is not an indicator for future performance, and Deepbridge Capital LLP is authorised and regulated by the FCA. Okay, today's webinar will cover, so we'll look at the Enterprise Investment Scheme and why it was launched, the tax reliefs available to investors, the different types of EIS funds and how they affect tax planning, which we'll go into further detail next week, risks associated with EIS investments and how an EIS exit works. Okay, we're going to start from the top as to what the Enterprise Investment Scheme is. Now, I appreciate on this webinar there'll be different people with different ranges of knowledge, so we'll start from the basics. So it's UK government initiative it's UK government initiative designed, is the word I'm looking for, to encourage investment into UK-based SMEs by offering generous tax reliefs to investors. So the purpose and the objectives, as you can see on screen, is to stimulate economic growth from the bottom up by supporting UK-based SMEs, create employment and encourage entrepreneurship and enterprise here in the UK, and of course investment from high net worth individuals. So I've mentioned the phrase SME twice here. So EIS companies, what we deem are typically at the SME stage. If they are startups, they may fall under SEIS, which I'll come on to in a few slides ahead. So while it's difficult to place an exact figure on this, it has been rumoured that for every £1 invested into EIS, in the long term, it contributes £3 towards the UK economy. So focusing on the timeline of key milestones before I come on to other milestones and actually the tax reliefs, let's focus on the milestones since inception of EIS in 1994. So of course there have been multiple minor changes such as funding limits, company age, qualification, etc., which I'll cover as to what the current rulings are on another slide. But this provides an overview of the most notable changes to help paint a picture as to where we currently are with the Enterprise Investment Scheme. So as I mentioned, launched in 1994. You may not be aware that the tax relief, the income tax relief for EIS actually used to be 20%. It was increased to 30% back in 2012. Renewable energy no longer qualified as a qualifying trade from 2016 onwards. And something that took a while in the industry to, I guess, adapt to was that capital preservation asset-backed EIS is no longer available on the market. It's all about growth focused. And within that, we've got knowledge intensive funds, which I'm going to come on to in this today's episode. 2023, good news that the SEIS funding limit was increased, which is great in line with inflation. So that was actually set in 2012, hadn't changed for 11 years, and now fortunately has up to £250,000 under SEIS can be raised. And good news, last year the sunset clause was extended. So when it was launched, it was initially in place EIS and VCT for 30 years, and it's now been extended for another 10 years, which will be reviewed at the end of that period. So a couple of key milestones. How much has been raised under EIS? £34 billion. Over 59,000 companies have raised capital via EIS funding. And in the tax year 23-24, because it takes a couple of years for data to come through, there were over 35,000 individuals that had submitted tax relief claim forms. So this is the way that HMRC actually count how many investors there are into EIS by return of the EIS 3 or 5 certificates. It's their data collection tool. So I'll go through the difference between EIS 3 and EIS 5 shortly and what that means in relation to which fund someone's invested into, which type of fund. So I think to bring EIS to life, let's look at a few notable companies that have actually raised capital under EIS. So as I've mentioned, over 59,000 companies, a few that we'll deem mainstream on screen here. So Brewdog completed a few rounds of fundraising through EIS in early 2015, what they called Equity for Punks. Hosted another round in 2018 via Crowdcube. Moneybox raised EIS capital through multiple platforms and managers and recently achieved a 17x for some investors. Gusto, the home food cook kit, raised EIS capital in 2016. He's now achieved a unicorn status. So they are companies that are valued at £1 billion and above. And we've got Flagstone, which the investment platform, which raised £2.6 million in EIS, or sorry, through EIS in 2022. So how does a company qualify for EIS funding? I appreciate it's a lot to take in on screen here, but I'll just go through and highlight a few key points for consideration. I appreciate it's quite text heavy, but the main focus should be, for now, is at the bottom. So to highlight two final points, risk to capital refers to what I mentioned on the inception slide, where capital preservation asset backs no longer qualifies under EIS. It's all about growth focused, and from that, a full investor's pound that they invest should be considered at risk. So referencing the qualifying trades, most companies do qualify, but examples of disqualifying companies include dealing in land, money lending, property development, renewable energy, which I mentioned was outlawed in 2016, shipbuilding, steel production, and hotel operation. Companies will submit information to HMRC to receive what is called advanced assurance, which is effectively a letter to state they qualify for EIS funding. Companies must be careful, of course, that the underlying trade does not change or breach any of the above requirements in their time that they're actually raising EIS capital. As you can see at the bottom right, I've added an asterisk as from the start of the 26-27 tax year, some of the company limits will be relaxed when they're effectively doubling. So that was actually mentioned in the budget, so the most recent budget. So for example, the maximum an EIS, a company qualifying for EIS can raise in a 12-month period will go from £5 million to £10 million. So I mentioned this earlier of what is a knowledge-intensive company. In short, this means that some of the limits are relaxed for those companies raising capital to ensure they're carrying out relevant R&D and meet various conditions. So I appreciate this on the right-hand side, again, small text. This is a screen grab taken from our website, so deepridge.academy. You can access what you can see on screen here and much further information, detailed information at whenever you need it. Please go to our website. In the top right-hand side, you'll see a button for Academy, or you can just visit deepridge.academy. So the full knowledge-intensive qualifying criteria can be found on this, and this isn't, of course, to be confused, which I'm going to come on to shortly, between a knowledge-intensive fund. So a knowledge-intensive qualifying company and knowledge-intensive qualifying fund are two different things. So at the start of this webinar, I mentioned the phrase SME, which would typically fall under EIS fundraising. So SEIS qualifying companies, so Seed Enterprise Investment Scheme, typically refer to companies that are deemed startups. Now, you can see on screen here the differences between the two and the qualifying criteria, which gives a bit of emphasis that the companies on the right-hand side are under SEIS are startups. So, for example, the maximum amount of employees a company raising capital under SEIS can have is at only 25. So the reason why I've got this on screen is really just to distinguish between the two, because I still have conversations with advisors that EIS companies are startups when, if they are startups, it makes more sense for them to be under SEIS because investors, of course, get the added tax relief, which I'm going to come on to on the next slide. And again, I've just put an asterisk there for company limits increasing from 2026, or 6th of April this year. Okay, arguably the huge appeal to investors are the generous tax reliefs on offer. So let's go through them, looking or focusing on the left-hand side, because this is about EIS investments today. Okay, on the income tax side, I'm just going to get my pointer up. So hopefully you can see that on screen with my laser pointer. You'll notice under the 30%, it says 30% carryback. Now I'm going to come onto this on the following slides ahead as to what that means. With SEIS, you've got 50%. And of course, with VCT, you do have 30%. However, as one of the budget changes, you may well be aware that that is decreasing to 20% from the start of next tax year. The minimum term refers to the duration for when the tax reliefs aren't clawed back. So if someone invests today, they would need to be invested for 3 years into a company to ensure that the tax relief isn't clawed back. And I'm going to come on to what an early exit may well mean for an investor and associated to the tax reliefs later on in this webinar. Just scroll down a few bits here, a few rows, sorry, dividend. So it should be noticed it's very likely the situation dividends are available to investors, as typically EIS companies are in their early stage journey, so might not be at profitable stage yet. If they are, then they are taxed. Now, probably one of the benefits to VCT that I'm going to compare between EIS and VCT on the next slide. There's a huge benefit to VCT, of course, over EIS, is that dividends are tax exempt. You also have CGT deferral, a conversation I'm having more and more with advisors, particularly with clients disposing of properties in the last few years. So there is actually no upper limit on investment for CGT deferral. The key here is a time frame for an investor to claim CGT deferral, which is 12 months before or 36 months after the date of disposal of the asset. Now, next week, I've got a case study on this as an example of someone that has disposed of a property in the last 12, 24 months. They can technically still defer via EIS if they wish. You'll notice under SEIS in this column here, you'll notice 50% mitigation. So not deferral, but half of the gain or the tax is actually wiped out by an investment into their SEIS. Now, IHT exemption. Unlike VCT, EIS and SEIS, the shares are business relief qualifying, meaning that after 2 years of holding them and on death, they will be IHT free. And loss relief is also available. So this is available for companies that fail. So it's typical in a portfolio that some companies will fail along the journey. And again, an example I've got in, I believe it's next week's episode on how loss relief works and the calculation about how to get to it, and a typical example of how EIS portfolio may look. So something I usually say on this slide, if this is of interest in particular, firstly, the webinar recordings will be available in the coming weeks. But if it's of interest to have this to hand now, if you press print screen on your keyboard, I'll just give you 10 seconds to do so. You can then save this as a picture. So I'll just give you 5-10 seconds to find print screen, which is usually top right on your keyboard, and just have that to hand if you'd like this as a bit of a cheat sheet to access it in future. Okay. Is EIS an advantage over a VCT? So a common query that I receive, and some advisors think that the tax reliefs can be the same. So let's just actually go through the differences. Some of them are the same, but let's just go through the slight differences between the two. So yes, as it stands, the income tax relief is still 30% for both. As I've mentioned in the previous slide, 20% will be the new income tax relief availability for investors in VCT from the start of the next tax year. But a big thing I'm discussing at the moment, I'm going to come on to this shortly, is about carryback. I've got this on the next slide, so just keep that in mind as to what that means, and I can delve further into that. The minimum term is slightly different for VCT, so 5 years to retain all tax relief, whereas 3 for EIS. The maximum investment, again, is slightly less for VCT, so £200,000 per tax year, or £2 million, or potentially 4 for EIS if an investor is doing current and previous tax year through carryback. Again, I'll come on to this shortly about carryback. Dividend, as I mentioned in the previous slide, that it's tax exempt for VCT. So at the bottom here, you can see I'm doing almost a scoring system to see about who has the sort of better tax relief available to them. Growth is tax exempt across both. CGT deferral is available for EIS, but not VCT. IHT benefit that I mentioned as well, business relief qualifying under EIS, but not VCT, and loss relief is available for EIS, but not VCT. So just look at the tax relief qualification for the investor, just taking a step back on the tax reliefs associated with EIS. Let's just look at this from an investor perspective first. So of course, each individual's personal circumstance will differ, but there are some requirements to benefit from the release acquired through EIS shares. So just to talk you through a couple that I've highlighted here. To claim the 30% income tax relief on the subscription of shares, investors need to have sufficient tax for the current and or previous year, which I'll discuss on the next slide. Investors must subscribe to newly issued shares and not acquiring secondary ones to receive tax relief. So if someone gifts their EIS shares to a friend, for example, it doesn't mean the tax reliefs will pass on, and the tax reliefs, for example, the person that's just acquired the shares as a gift will not be able to claim 30% again. Investors' interest cannot exceed more than 30% of the total share capital in the company. No connection to the company, i.e. cannot be a director or an employee and receive 30% tax relief on the way in. However, with CGT deferral, there's some added tax reliefs. So must be a UK resident at the time the CGT liability arose and at the time that the investment into the EIS is made. Connection requirement doesn't apply, so a director technically can have a personal gain and actually reinvest it and claim CGT deferral into their own business. And there is no upper limit for deferral. So I've mentioned about claiming tax relief on the previous slide of potentially £2 million or £4 million if utilising carryback under EIS. That is usually associated to the maximum income tax relief claim. Whereas CGT, there is no upper limit. So technically a director could have a personal gain of £10 million and defer it back into their own business. So a phrase I mentioned earlier is carryback. So what is carryback? So an EIS or SEIS investment can be treated if it was made in the previous year, therefore applying the income tax relief to that specific year. So again, it's quite text heavy on screen here, but I've got it in bold. Hope you can see it again with my cursor. That's a HMRC's statement. So for example, and again, I'll give a further example of this next week in a case study. If a client makes a £10,000 investment and they receive 30% income tax relief on the way in, they can claim that £3,000 against the current and or previous tax year if they wish. So as you can imagine, put it into practice at this time of year, many investors are looking to invest now to claim carryback to the previous tax year. Now that is provided that the provider, i.e. Deepridge or other providers you're familiar with on the market, actually invest or deploy the capital this tax year. And again, I'll go into that further detail next week, but also that will make sense when I come on the next slides about the difference between two types of funds and what it actually means from an investor's perspective in claiming tax relief. And again, just to confirm, this is not available for VCT investors, so this is just under EIS and SEIS. So a phrase that I mentioned throughout this webinar is knowledge intensive, which until this point has referred mainly to the qualifying company status rather than the two different types of funds. So to add confusion, as it may sound, you do have knowledge-intensive qualifying companies, but also knowledge-intensive qualifying funds, which used to be known as approved funds. So the more common fund on the market you may see is unapproved or conventional fund. I'm personally not a huge fan of the phrase unapproved. It makes it sound like a tax avoidance scheme. But the majority, for market context, the majority of funds available that are open at the moment on the market are unapproved or conventional, as is probably the preferential phrase for them. As of last week, I did check on MyCap. So if you've used MyCap before, it's a bit like a Go Compare tool, if you like, of tax efficient funds. There were 42 unapproved funds open and 7 knowledge-intensive funds open. And just something I've taken from Intention Partnership, an advisor's guide to EIS, just to talk you through this. So unapproved funds don't have as many constraints as a knowledge-intensive fund, therefore giving them greater flexibility and therefore makes up the majority of the funds available on the market today. I'm now going to show you the differences between the two types of funds. So the tax treatment date under a conventional fund is when the shares are allocated in the underlying companies. So for example, if you send in an application form today to a provider, that doesn't necessarily mean that the tax relief applies today or tomorrow. It is when the provider allocates the shares in the underlying companies that are open in that fund, which we're going to go on to next week from a research perspective. That is probably one of the key things to look for as when you're considering providers, or many, I'm sure there'll be paraplanners on this call, when doing your research. That is one of the things to look for in a conventional fund, is to when the shares are actually allocated in the underlying companies, because that is a key date for when tax relief will apply to the investor. Now, with a knowledge-intensive fund, it's slightly different as to when the fund closes. So again, when you're conducting your research, look when the tax treatment date will be, which will be the fund closure date. So typically for a knowledge-intensive fund, it will be towards the end of the tax year. So it may state on their literature, other providers, the 1st of April. So then you've got certainty the fund will close this tax year. Therefore, your investor can claim tax relief against the current 25-26 tax year or carry back to the previous if they wish. So other considerations and differences between the two. So with a conventional EIS fund, there is one EIS-free certificate per company investment. And I've got this coming up just to show you what an EIS-free example looks like and how investors actually make their tax relief claim. So to confirm, there'll be one EIS-free per company allotment in the conventional funds. For example, if there are 10 companies, then there'll be 10 separate EIS-free certificates. And with a knowledge-intensive fund, there'll be one EIS-5 form that covers all investments. However, 90% of the capital that has been invested into the fund needs to be spent first before this is produced, which must be done within 24 months. I think just given my experience, I've spoken to advisors on the deep bridge USPs, which I'm going to come on to in episode 3 regarding our proposition is that we deploy the capital quickly. And I did speak to an advisor not too long ago that said he invested in a knowledge-intensive fund alongside deep bridge, and the EIS-5 had not actually come back for over 2 years, despite the process starting all that time ago with the application form, the fund closing, but obviously the capital within that hadn't been spent, so therefore the EIS-5 couldn't be produced. Now, what that means from the investor's perspective, of course, is they will have done their tax return, paid their tax to HMRC. From a cash flow perspective, they're simply waiting for that form to come back to then amend their tax return to then get their tax relief on the tax they've already paid, if that makes sense. But again, I'm going to come on to that as we go ahead in this webinar, just for a bit more context. And as I mentioned, to add confusion, even more so, in a conventional fund, you can have knowledge-intensive qualifying companies within them. So to confirm, a knowledge-intensive qualifying company just has the limits relaxed, provided they prove there's certain R&D undertaken in the qualifying trade, and a certain amount of the senior board have relevant higher education linked to the company and what trade they're in. Whereas a knowledge-intensive fund is required to have at least 4 companies overall, and no more than 50% of capital within the fund may go into one specific company. So you need to diversify it into at least 4 effectively plus. And again, what I'll do is in the episode ahead, which will be episode 2 next Thursday, I'll give you how a typical approach would work from an EIS fund perspective, how many companies they'll be allocated to, how the tax reliefs work. And on the next slide, I've actually got what a EIS-free certificate looks like, the context. So to claim tax relief, an investor will need to be in receipt of what you can see on the right-hand side of your screen here, which is a copy of an EIS-3 certificate. Now, as I've mentioned, there are an EIS-3 and EIS-5. So to confirm, each company investment there is made to say an investment, or you place an investment in the EIS, there's 10 companies, there'll be 10 separate EIS-3s, but only one EIS-5. As I said, they cannot claim their tax relief until they're actually in receipt of this. So what I've got on the screen on the left-hand side is actually working backwards. So as I've mentioned, the top part there, tax relief can only be claimed with the relevant tax relief forms. This typically takes a few months with an EIS-3 to come through from HMRC, 2 to 3 months, possibly up to 4 after deployment. Step prior to that is the process, of course, can only begin once the capital has been deployed. And something for paraplanners or advisors considering research to start the process with recommending an EIS should be deployment timeframe considerations, particularly from a tax perspective of the investor if they're utilising carryback or perhaps CGT deferral, or even from a BR perspective where they wish to start the 2-year clock as soon as possible. Now, one of the burdens over the years of, I joined the industry back in 2015 and everything was paper-based. So fortunately, not only Deepbridge, but other providers in the market, also HMRC now produce these digitally. One of the burdens over the years that I've heard mainly with investing into EIS has been there's been so much paperwork of EIS-3 forms you can see on screen here, valuations, company updates, etc. all coming in the post. If you've got 10 separate companies, there's 10 lots of potential paperwork going to your client that is littering their doorstep effectively. But now HMRC are trying to be fully tech-based, and particularly with Deepbridge, I'll go on to in episode 3, is showing our portal that we have available to access for advisors, support staff, and also even investors as well. So if I may, just before we go to the next slide, just how this actually works is an investor will submit their form back to HMRC. It's always a verification process because HMRC, you probably can't see this on screen, but the key information here will be unique investment reference number, the date of shares issue, which is the key information, obviously the client's name, so the investor's name. HMRC have produced this form, and when they then receive it back, it's a validation process to them that they can then issue the tax reliefs. So yeah, that's typically how it works. And as I've mentioned, once deployment's taken place in a conventional fund, it's usually 3 months from that HMRC take to return the forms. Now, talking from Deepridge's experience only, our record was 8 days. And then the average time frame, as I said, is usually 2, 3, sometimes up to 4 months. So just to manage the client expectations on when they actually get their tax forms come through. So I'll put this slide as busting a myth. So the myth sometimes is investors haven't got their tax relief forms, tax certificates, EIS 3 or 5, in a certain tax year. And there's been a bit of panic when I've spoken to advisors that they're going to lose their tax relief. So this isn't the case. So investors do not lose their relief if they haven't got it in a certain tax year that they invested. The overall time limit to claim income tax relief or other reliefs for that matter is 5 years from the 31st of January following the tax year in which EIS shares are issued. So if we take into account today's date, if someone invested today, the claim limit would actually be the 31st of January 2032. Now, of course, we don't want EIS 3s and 5s to take a number of years to come through, but the reality is that potentially could happen. So the absolute limit window for investing, say, today would be 31st of January 2032. So to summarise, we're making an investment into an EIS, look at the fund structure, as this will determine when the certificates actually come through. But the key consideration from a taxpaying perspective, as shown on screen, bottom left, should perhaps be the difference between the approved or unapproved side is actually when the shares are allocated or the fund actually closes, and then conduct your research also from there. As to the appropriateness of the investor, what their tax reliefs are tax planning they're trying to achieve. Is the provider suitable enough? But again, I'm going to go through this in episode 2 on what to look for when reviewing or researching providers in the space. So how to claim reliefs on a tax return. So I'm not going to go through this fully today because I appreciate time. We've probably got about 10 minutes left today. But what you can see on screen here is a video, and hopefully this is rendering okay for you on your screen. This is available on the Deepridge Academy. So again, go to our website, top right says Academy. We can assist you with claiming how the tax reliefs are claimed, but usually this is with an accountant to do so. But yeah, this is there on our website in case you need that as a reference point. So when investing into an EIS fund, it's important to consider the risks. So we're going to go through a list of potential risks shortly, but here on screen emphasises the differences arguably and the importance between investing into a managed fund or investing directly into a single company that qualifies for EIS. As advisors and paraplanners, I'm sure you consider the first rule of investing is for a client to not all put all their eggs in one basket. So on a managed portfolio example on the left, you can see that in a portfolio of 10 companies that 5 companies have failed and 5 have exited successfully. So despite there being a 50% failure rate, which we're hoping isn't that high, the overall outcome is a successful investment if we assume successful exits at various profitable multiples. So next week, we'll go through this example in a further detail and actually show the tax reliefs on screen and how this actually works per separate entity or company and how the specific calculations actually come to a further bit of detail that you can see on screen here. So in the comparison on the right, you can see an example of the risk taken in investing into just one company. If the company fails, then the whole investment fails. So there are plenty of benefits to choosing a managed portfolio or fund provider, such as rigorous DD initially to make sure that it's a company that has got longevity or potential upside and potential. And so managers also have an interest on behalf of investors, typically taking a board seat. And post year 3, that the managers, like the likes of Deepridge, will seek a suitable exit post that 3-year mark to ensure that the investors are outside their tax loop. So Deepridge and other providers always have the interests of the investors at heart. Now, it wouldn't be honest with me to not highlight the risks associated with the EIS, as of course they should be deemed high risk, as I mentioned with the regulatory slide at the start of this webinar. And tax reliefs are given ultimately for investors taking a risk. Now, I describe it as an upfront compensation for taking a risk with capital. So a few key things to consider here. Liquidity. So arguably the main risk with an EIS investment is the investor's capital will be tied up. So effectively what you're doing is investing into a company and they're spending that capital, so they don't have the liquid cash available to provide capital back to investors at their beck and call. So that should be the main thing highlighted to an investor in your report is liquidity, is that ultimately the capital is locked up until an exit opportunity arises. So company trade, I mentioned earlier about disqualifying trades. So a real life example, and some of you may be aware of, a City Pubs EIS. So they had to be careful. Disqualifying trade didn't account for more than 30% of income. So an example of a disqualifying trade for them would have been trading in the hotel and B&B services. So usually pubs, as we know, have B&Bs above it, but does the trade contribute more than 30% in the B&B side than the pub? Unlikely it does, but that is at least one thing to be considered nonetheless to ensure that the company qualifies, going forward. Tax risk. An EIS company exiting within 3 years could result in income tax relief clawback. Dilution. For investors, this can diminish their investment value should the company issue new shares to raise additional capital. Failure. It is potential that all of the investments within the EIS fund could fail, and that is a potential reality because, again, these are deemed high-risk investments. You're investing in UK-based SMEs, hoping that they scale up and commercialise to get to a value point to exit. Investor tax relief qualification, which I covered. So, for example, a risk to the investor could be regarding the CGT deferral. Were they a UK resident at the time the gain was arisen? And EIS exit within the 3 years, so a tax relief withdrawal. So a company could successfully exit within 3 years. However, the income tax relief could be withdrawn because it's within that 3-year time frame. So how does a company typically exit within EIS? So as you can see on screen, there are typically 4 methods of doing so. Initial public offering, so a company lists shares on a recognised stock exchange, providing and liquidating opportunity to investors. Arguably the most common is a trade sale, so companies will have EIS investment, get into a certain value point, and then the blue chip companies may well come in and acquire their IP or buy the company as a whole, providing liquidity to the early stage investors. Management buyout, quite self-explanatory. Liquidation of assets, the company's wound up and assets are sold with proceeds returned to shareholders. A viable option historically with renewable energy EISs had been that there have been tangible assets of value, so actually post year 3, sell down the assets or sell on the assets and provide returns to investors. So as discussed earlier, the benefit of investing into a managed fund is that the manager will seek an exit and negotiate the best possible terms for investors post year 3. With a single company, you are simply at the mercy of when they may well exit or when an exit opportunity arises. So if there is an exit, let's look at the tax implications for investors. This is the last subject for this week. Got a couple of slides ahead, but this is the last of the content side of things. As I've mentioned, withdrawal of income tax relief for a company exit within 3 years, the income tax relief will be withdrawn. This may not always be a negative scenario, because, for example, if a company exits at 10x within 3 years, then it's a slight blow, of course, getting the tax relief withdrawn. But if it's a 10x, then it balances out in a more beneficial way to the investor. A deferred CGT crystallizes. So if you invest into an EIS fund, a deferred gain will be split across multiple companies. Do remember, so with an EIS, say, for example, there's an investment of £100,000 or 100k gain has been deferred and it's spread across 10 companies. One company could exit on year 3, and then there's a portion of that gain that is actually revived at that time. So it's not the £400,000 because they're separate entities. It will be revived at that time. Now, years gone by, it's been quite useful to have a staggered exit approach with deferred CGT, because when the annual allowance for CGT was 12,300, that could be used against that 10k, for example, for that year, assuming it was exited in 3 years, 3, 4, 5 years time, whenever, and the annual allowance hadn't already been used by the investor, actually lowered the actual CGT that was deferred and actually repayable back to HMRC. So yeah, the deferred CGT crystallizes upon an exit. An option could be for an investor to potentially reinvest back into an EIS, keep claiming deferral, keep claiming, again, 30% income tax relief because it's a new investment completely. We've got loss relief as well. So if applicable, the calculation is, if a company exits, subscription minus income tax relief. And again, I've got this next week, and I'm going to show you a worked example and a calculation of how loss relief works for failing companies. And no capital gains tax on profit, so no reporting required. One technical detail to consider, this is in the fine print of HMRC's website, is that income tax relief must have been claimed in full on the original subscription for this to apply. So if you are investing a client into an EIS, they have zero income tax and they're just doing it for CGT deferral, for example, or just because they are excited by smaller companies, and it exits, let's say 300k, there would be gains or CGT to pay on those profits because income tax relief wasn't claimed on the subscription of the shares. It's a fine caveat they've got with HMRC, but that is one of the rulings, just to mention that. Okay, so that takes up 35 minutes. So today's webinar has covered what is Enterprise Investment Scheme while it was launched, tax relief available to investors, different types, so I compare between an unapproved or conventional fund and a knowledge-intensive fund. I've discussed the risks and also touched upon how an exit works with EIS. Next week, I'll be discussing case studies, so putting a lot of what I've just mentioned into real-life examples, talking about how the tax reliefs work, what to expect from an investor experience, as I've mentioned, when the money will be deployed, when their tax relief forms will come through, and how to claim the tax reliefs as an example and considerations. And advise and paraplanners, considerations to make from a research perspective when placing an EIS case. So you may be familiar with my colleagues on screen here, depending on where you're based around the country, but here is your support. So please get in contact with us. As I said, this is a live webinar, so I'll be available following this webinar if you do have any queries or questions, and here is my details on screen. But hopefully you signed up to this webinar to attend all three. As I said, it'll be 9:30 again next Thursday to look at case studies. CPD certificates will be sent if you can't make next week after each episode. And this will be the end of episode 3, but there will be a survey sent as well. So please, this will help us improve any content to make it more relevant. Anything you did or didn't like, please take the time, just 2 minutes, to fill out our survey. So I'm just going to quickly look at the Q&A. Matt, yes, as I just mentioned, so your question came in about 10 minutes ago. Yes, you will get CPD certificate, and a copy of the slides will be made available. So we will send a recording due to compliance. In a few weeks' time, we will send the recording once it's been through and approved by our compliance, probably towards the end of February. We will make a note to send this through to all attendees. So yes, they'll be made available by a video format. Okay, thank you everyone for joining this week. Hope you can join me again next week. I appreciate, again, we had over 150 register, so really positive there. As I said, any questions, my details on the screen, and we look forward to seeing you next week. Have a good day. Thank you.